It's very different and very empowering. I think that these software libraries and not only the access to the libraries, but the amount of educational and training material that is now available to people is really astounding to me. Back then, you had to learn from other people who knew how to do it, or you had to go and buy the textbook at the Rand McNally bookstore in Manhattan and read that. You really had to seek this information out. And now today, there's just unbelievable amount of resources and training. And honestly, lately with what ChatGPT is doing, it's really incredible what's available to hardworking entrepreneurial people. They can access these tools at a level I never thought I would see.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights, Stand Out and Supercharge Your Assets. I'm your host, Roger Silk. Our guest today is Ed Condon of Structured GRAT. Ed's deep involvement with structured investments, which he will be telling us about, started at Morgan Stanley when he was on their equity derivatives sales desk in New York. From there, he expanded his role to equity derivatives, say that 3 times fast, with Credit Suisse, where he helped build the structured note coverage team. And don't worry, if you don't know what that is, we'll be talking about that. That team was spun out as Financial Products, LLC, which is a boutique broker-dealer that Ed co-founded. He has also held key executive positions with Halo Investing, a Chicago-based fintech, and he'll tell us what that is. And he was the head of broker-dealer operations, the head of the marketplace, and SVP investment solutions, and probably quite a few other things. Ed has an undergraduate degree in physics, which is always a good sign for somebody's abilities. And he has an MBA in finance and statistics from NYU's Stern School of Business. Ed, thank you so much for joining us.
Roger, thanks for having me. Much appreciated.
You've got a ton of interesting things that even just reading your bio makes me want to ask you about.
Sure.
Let me start maybe near the beginning. So how did you go from physics to finance, even at the studying level?
Great question. I like to say that if you're born in Los Angeles, you're destined to go into the movie business, right? But if you're born in New York City, you're destined to go into finance. And that was my predicament, right? I was born in Brooklyn and grew up in Queens, New York. And if you had a head on your shoulders, that's what you did. You went into New York City and you got a job at a bank, at an investment management firm. And that was my mindset as a young person in New York. I wanted to succeed, and that was the path that was there for me. Studying physics, as we were talking before we came on, For me, that was my passion at the time. I love science, I love mathematics, and I wanted to make good use of the 4 years that I had in college. And so I chose that from the very beginning, but I never really had an intention of becoming a professor or a physicist. I just wanted a very solid education. And my intention all along was to work in finance in one form or another.
So then, how many years were there between Lehigh and business school?
Just it, it's a great question. And it's funny. The real answer is as many years as it took me to find an employer that was willing to subsidize my tuition because I went at night at school. I applied to Columbia and Fordham and NYU, which are the big three in New York. And Columbia was a full-time program. They did not have a night school. Fordham was too difficult for me to get myself to. So I ended up at NYU. And I think it was about 3 years between graduating and then actually matriculating.
So it's been a while, but Fordham has some presence in Manhattan, but when you were doing it, you would have had to go where?
Yeah, so now I'm really dating myself, Roger. When I started that MBA program, NYU's business school campus was actually in the World Trade Center all the way downtown. About 2 years in, they moved that campus to West 4th Street, where the main NYU campus is. So
Yeah.
still kind of downtown, not all the way downtown.
When you were at NYU, were there any big names teaching in the program that you studied with?
Yeah, no, honestly, not that stood out to me. For me, it was a little bit more about networking with my fellow students and when you're going at night, it's a real hustle, so to speak, right? Like
Yeah.
you've been working full time all day. These classes were 7, 8 o'clock at night, and you're going 3 nights a week. It was long days. And for us, it felt more important to network with your fellow students.
And as undoubtedly it was.
Yeah.
Do you want to give just a very brief overview of how finance and statistics, that background, informed your ability to build all this structured product stuff?
Sure. It's funny because when you study both of those subjects, finance and statistics, the intersection of the two is essentially analysis and analytics. And so I became very interested in computer programming and database design and programming. And so my first big job was at Avatar Associates as a quantitative analyst. And there I developed programming and data analysis skills and ultimately had a team of programmers working with me. And that's how I learned how to create investment backtests. So
Uh-huh.
the ability to create the right database and the right algorithms sitting on top of that database to backtest various scenarios.
When
So
was this, Ed?
I'm sorry.
When was this?
I was with Avatar between 2000 and I'm sorry, wow, 1991 to 2001.
Okay.
Yeah.
So what languages were you using then in that era?
So I primarily used three different languages. One obviously was SQL, right, which is the main kind of database querying language. I chose to use Visual Basic because it was an up and coming, that was the Excel macro language at the time.
Yep.
And Microsoft was pushing it, and it was a good language to build interfaces with. And I used a data processing language called AWK. It's not around anymore, but back then that was the kind of cutting edge standard for doing data processing. Now, it's funny, Roger, back then we didn't have pandas and NumPy and all of these different pre-built libraries that come with Python now. Those things were actually being built during that time by other people like me that were a lot smarter than me.
As they say, the kids these days don't appreciate
Correct.
I remember when I was in graduate school and I had a data tape. Remember those?
No,
And
sure.
it was in Epsodic. and the school's computers ran on, they were DEC machines, and so they didn't speak AppSudic. So I had to like figure out how to mount this thing and get the DEC machine to read an IBM format and then translate it into ASCII so that the DEC machines could. So yeah, it's a little bit different now, isn't it?
It's very different and very empowering. I think that these software libraries and not only the access to the libraries, but the amount of educational and training material that is now available to people is really astounding to me. Back then, you had to learn from other people who knew how to do it, or you had to go and buy the textbook at the Rand McNally bookstore in Manhattan and read that. You really had to seek this information out. And now today, there's just unbelievable amount of resources and training. And honestly, lately with what ChatGPT is doing, it's really incredible what's available to hardworking entrepreneurial people. They can access these tools at a level I never thought I would see.
It is astounding to me how good of a programmer, at least for basic stuff, ChatGPT is now.
It's incredible. It's really incredible.
Because
And
it can do like in like as quickly as you can practically type it, it can do something that we sweated for a week on when we were learning this stuff.
yes, exactly. Exactly. It's very true. I will say, Roger, one of the things that I got really lucky with back in the 90s and early 2000s when I was doing this work was I made a decision early on to choose a design path based on object-oriented programming. And that was a brand new concept back in the mid 90s. Not not everyone was using that design concept. And but I guess by sheer luck, I just looked at it and I said, oh, this looks like it's going to be the next thing. So we might as well start doing this now. And we might as well start as a team, wrapping our head around it now. And boy, did I get lucky with that, because now, fast forward to today, everything, absolutely everything is object oriented in terms of design. And so I've been lucky enough to be doing that for 25 plus, almost 30 years.
Yeah. What do they say? Better lucky than smart. Although
Uh,
I suspect it was some of both.
I like to try to think ahead sometimes, and sometimes too far ahead. And you can be early sometimes, and you can also miss the mark. But on that one, I got lucky.
So I want to ask you now, Ed, assume that our some of our listeners don't know what structured investments
Mhm.
mean. Can you give like a high level overview and then we'll go into some of the more detailed areas?
Yeah, sure. So structured investment, which is also called structured note or structured product, right? They all three terms refer to the same thing. It's essentially a bond that's issued by a financial institution like a bank or an investment bank. And banks have to fund their operations by issuing debt, so they're medium-term bonds all the time. The key difference between the bonds that they issue normally and the bond that they issue as a structured note is that the payoff of that note at maturity is dependent on some other thing, like a equity asset or some index or an ETF. There's some other asset or benchmark that the payoff of that note is linked to. That's the kind of determining difference. Now, you know, what I like to, there's a quick story I love to tell to give people an idea of what a structured note really is. If you'll indulge me, I'll tell it to you real quick because
Yeah, please.
yeah, it gives you a good understanding. So basically, in the 70s, when the markets were being deregulated, it, wealthy investors wanted access to currencies and commodities and all of these other asset classes that they couldn't get access to. At the same time, we were seeing listed option markets come online. Okay, so for the first time, you were able to trade options and long-term options on equities and even equity indices. And certain advisors came up with a very simple idea. They said, hey, if you give me $1 million, in 5 years, I'll guarantee you, I'll sign a contract that says I'll give you your $1 million back in 5 years. But if the market, the equity market is up, I will also pay you whatever that upside is. And, a lot of investors like that idea. So they funded these accounts, signed the paperwork. And what those advisors did was they went into this new options market and they bought long-term call options on the Dow and the S&P and on the stocks in the Dow. And what they did then was they said, okay, I'm going to take, let's say, $825,000 of your million, and I'm going to buy a 5-year zero coupon bond, right? And so doing that took care of that promise to give you your money back. And then by buying those options with the money that was left over, it was simple. If the market was down, those options expired worthless. And if the market was up, those options would go up with leverage compared to the original million I started with. And so that scenario was pretty attractive, and a lot of people were doing that back then. You may recall some of those strategies being shopped around there. It was popular. Okay.
Mm-hmm.
But the drawback to it was that it was a pain, right? The client had to open up different accounts. You had to have collateral to trade the options. If they couldn't really tell how they were doing, so pricing wasn't exactly transparent, right? Like you couldn't really see what was going on at any moment in time. And if I, as the client, wanted to access some of that money for whatever reason, you as the advisor, you had to go in and unwind all of these individual positions and liquidate things that you maybe didn't want to liquidate. And so it was kludgy, to use a weird term, but it was clunky, let's say. So some banker in Switzerland came up with the idea of saying, hey, I can do that same thing. I can buy that zero and I can buy those call options and bolt them together. But I'm sitting here at the bank, right? So I can do that strategy from this trading desk I'm sitting at. And my bank can issue a note that says on the front page of the note, hey, look, I'm going to give you your money back in 5 years. But if the Dow Jones is up, I'll pay you whatever that upside is. And if it's down, you just get your $1 million back. And so what they did was they issued the bond with that written on the front page of it. And in the background, the trader at the bank, he just did that same strategy that those advisors were doing. He bought the zero coupon bond, and then he bought some call options, at the money call options. And so what they achieved by doing that was, first of all, they got some price transparency, because now the client, all they had to do to see how they were doing was look at the price of the bond, right?
Yep.
Okay. They also provided that client some liquidity, because now if they needed the money for something, they could just sell that bond back to the issuing bank. It was easy. But what it did for the advisor, and this was crucial, was it made that strategy available and also scalable in their book of business. Because prior to that, I needed $1 million from you to make that work. But now, if I'm just buying pieces of a bond, I can buy 2,000, 5,000, 10,000 at a time, and I can just put that across my book of client business. And now I'm essentially taking this sophisticated institutional strategy and I'm making it available to my clients across the board. And that was the true innovation of structured investments and what they accomplished for clients. And then from there, it just took off. Now there's all different types I described a very simple strategy where you're
Right.
just getting upside exposure. Now, today, we have much more complicated strategies where there's yield products and there's growth products and there's target return products. There's a whole array of different things that you can do because the industry's matured considerably.
And what are you guys?
I hope I didn't take too much time with that, but
No, no,
it's
that was a
been,
very, hopefully it was very clear to me. Hopefully it was equally clear to anyone listening.
sure.
What are you doing now? Like your firm now, your
Mhm.
principal, are you the founder?
I am.
And so what are you guys doing now that is maybe uh,
Sure.
of interest to people potentially?
Sure. So what we do now is we create structured note portfolios, specialized structured note portfolios that are used inside of Grantor Retained Annuity Trusts, also known as GRATs. Now, a GRAT is a trust structure that's used for a specific purpose for very high net worth families and high net worth individuals to assist them in transferring assets to their beneficiaries outside so that they're not using their gift tax exemption. Right? It's a common trust structure for that purpose. Now, it turns out that there are certain asset classes that lend themselves to a GRAT. Assets that are illiquid, cash generating, and essentially can be discounted in some sense because there's a tremendous advantage to discounting the asset as it goes into the trust. And the kind of aha moment that I had many years ago was that if the one thing I forgot to mention was that the whole thing works exceptionally well if that underlying asset outperforms a hurdle rate that is published by the government. It's called a 75/20 rate. And so you can set the trust up so that you put the asset in, you pay the grantor an annuity every year, and if that underlying asset outperforms the hurdle rate, you are in a position where you can transfer some amount of wealth to your beneficiaries without using up your gift tax exemption.
And just so that people understand, the GRAT transfers essentially future growth from after the date of the funding of the GRAT.
Correct.
Yeah.
Correct. And so if the asset in the GRAT outperforms the hurdle rate, that's a win, right? And if the asset can be discounted when it goes into the trust, that's also a win. So
Right.
again, so the aha moment I had was, okay, I can actually create a portfolio of structured investments where each underlying investment is specifically tailored, customized to outperform that hurdle rate. Also, it turns out that structured notes, by their very nature, are illiquid, right? Now, in practice, there's a tremendous amount of liquidity. The issuer will almost always buy them back, okay? But it just happens that on the prospectus of a structured investment, it clearly states that the issuer is not obligated to provide a bid. So that's a great situation because you have a financial instrument that in practice is very liquid, but it states right there that the issuer does not need to provide, is not obligated to provide a bid, which means it can be discounted as an illiquid asset. So this combination of customization, the ability to create the note from scratch and have the terms be whatever we want, lends itself exceptionally well for this trust structure because I can dial the risk in for my client. I can say, hey, we're going to build this portfolio for you, and this is what we expect the outcome to be. And that's where we come in, and that's where my background came in, was I built an analytics platform that backtests a portfolio of structured notes with a Grantor Retained Annuity Trust wrapper around it, historically back to, let's say, 1980, produces these very valuable analytics that show what is the average outcome, what is the maximum, what is the minimum, and then we can also discern between positive outcomes and negative outcomes, and we are able to measure the percentage of time that the GRAT succeeds with a particular portfolio configuration. We get results where these GRATs are succeeding 95, 96, 97% of the time, depending on the underlying configuration. And the analytics allows you to dial this risk in for your client. So you can have this back and forth and say, hey, if we do 4 years with this amount of protection, that's going to succeed 96% of the time. And if the client's not satisfied with that, you can go back to the drawing board, reconfigure things until you have a success rate that they are comfortable with. So that's what we do, is we provide the analytics and also the sub-advisory services to actually create those underlying portfolios.
And who is or what's the profile of an ideal client for this product? Because obviously it's rather specialized.
So my clients are trust and estate attorneys, advisors who have high net worth families as clients, and also even sometimes accountants that have relationships with high net worth clients. The
Uh-huh.
ultimate client is a family office, a high net worth individual. You can imagine that for you to care about the gift tax exemption, you likely have assets in excess of $25 million.
Mhm.
So ultimately, the end client that would be interested in this is someone with a family or individual net worth between 25 million and 500 million. Once you get above 500 million, you're in a different realm and you're dealing with the actual derivative components that go into the GRAT as opposed
Sure.
to a portfolio of structured notes. But
Right. Yeah.
in that
Okay.
kind of middle market, in that range between 25 million and 500 million, this is an optimal solution.
Uh-huh. So I'm just curious if you have done analytical work on the grad itself. So I've looked at it, and so by law it has to be minimum of 2 years. There's no maximum, but the grantor has to survive the term.
Right.
So there's a practical maximum. Have
Right.
you figured out what's the optimal term for a grad, or does it depend on factors that you want to tell us about?
Sure, that's a great question, Roger. I will say our analytics platform is maxed out at 10 years. We don't really look past 10 years because the benefits of it really diminish at that point
By
because
the way, I agree with you. 2 to 10 and somewhere in between.
that's
I,
correct.
I agree.
Yeah, I've looked at many results from just running this, and I think the answer really is that if you're looking at 5, 6, 7 years, the results are all very similar, right?
Yeah.
So it really doesn't change until you get inside of 4 years, because now you're talking about some pretty decent market fluctuations on the S&P and underlying indices like NASDAQ and S&P and Eurostoxx 50. In those kind of short time frames, things can move around. So I would say the optimum is really what works best for the client, right? It's really going to depend on what term is best for their risk, because
Sure.
there's not going to be a huge difference in results between 4, 5, and 6 years, right? You're really just making sure that the time frame works for them.
Uh-huh. Now, who are the originators of these? Who are the obligors on the note? Like, who are
Yeah.
you lending your money to?
Yeah, sure. So it's all of the usual suspects on the street. The big ones are obviously JP Morgan Stanley, Goldman Sachs, Bank of America. It's all of the big investment banks here, but there's also European issuers. UBS is a big issuer here.
So I
Uh,
haven't looked at this in a long time. What are the credit ratings of those institutions these days?
they're all investment grade. Some are just above investment grade, Morgan Stanley and Goldman Sachs, but most of the European issuers are very solidly A and up, right?
Uh-huh.
But you will not see a issuer that's below investment grade.
Because obviously the reason I'm asking is no one or most people wouldn't choose to put some really, because in order for this to be worthwhile, it has to be for a lot of money, right?
Correct.
And in order for it to be worthwhile, it could be a big chunk of somebody's estate. And nobody would, in a normal world, nobody would put that in a single A rated bond or so spread them, or is it insurable, or what do you do about that credit risk?
So both. First of all, we always diversify, right? We would never create a portfolio where everything's a single credit. It's just you would not be acting as a fiduciary if you did that, right? What we do is we set up tranches where each tranche aligns with the annuity payment. So what we're doing is we're funding the annuity payment, because remember, that's an annual annuity that has to be paid to the
Right.
mentor. So what we do is if it's a 4-year GRAT, we'll have a 1-year bond, a 2-year bond, a 3-year, and a 4-year embedded in there. And typically each one of those will have a different issuer so that we can spread that credit risk around. If the GRAT is large enough, you can have multiple issuers on a single tranche. Typically, we're trying to keep individual credit exposure at around 20%. If you're going with JP Morgan, Bank of America, you can push that a little bit. I wouldn't do that with issuers like Morgan Stanley and Goldman and a couple others, but definitely diversification. You can insure those by buying credit default swaps. You need
Mhm.
to have some size, and that's going to cost sometimes significant money.
And in today's world, who are the counterparties on the credit default swaps?
It's the same people.
Yeah, okay. So
Yeah.
you're not really buying much because I remember that from,
Yeah.
it's a different story, but
Yeah.
remind me again why it was so vital to bail out AIG.
Exactly. Look, it's important to understand the risks you're taking when you build these types of complex portfolios. It's absolutely is, right? But at the end of the day, I'm not saying there's no risk in a financial institution, but what the government learned a lot from what happened in 0809. And, if you read the Treasury Secretary's book, he has a line in there that says his one regret was letting Lehman go out of business. Hank Paulson's book, he basically, that was his one regret. And
Yeah, yeah, no, you're definitely making a political bet.
yeah.
So if you, I suppose, since you're basically using, if I understand you right,
Mhm,
basically using bonds, which could be treasuries, could be treasury zeros for your bond
mhm.
portion. But the counterparty risk is somebody's got to write you whatever options it is that you need to do your strategy. And that's going to be for the most part, it's the same counterparties, isn't it?
Yes, but here's the key difference. Okay. A bond is not a pass-through security, right? A bond is just has to be paid according to its indenture, right? So unlike things like ETFs or funds or other vehicles that make certain promises, and it's a pass-through vehicle where I have exposure, direct exposure to the hedge. So like a buffered ETF, like Innovator has buffered ETFs, right? That's a pass-through vehicle. So they're promising me a buffer, but if they screw the hedge up, I own that hedge. So because it's a pass-through vehicle.
Oh, so you're saying that maybe there's a benefit in having one of these credits on the other side,
Yes.
as
Uh,
long as they don't screw it up too bad.
Correct, because it would have to the mismanagement would have to take the entire firm down. But if a
Right.
single
But
trader,
that could never happen. That's nothing like that's ever come close to happening.
we all have the same experiences and memories with that. But like I said,
Yeah. No, I find it, this is completely off topic, but I find it absolutely mind-boggling that the regulators permit banks to basically run giant hedge funds on the side with the customer's money. I think that's outrageous.
right.
But,
Yeah.
and that's
Well,
what creates the risk, right? It's not the banking business that creates the risk. It's the hedge fund business that creates the risk.
yeah, it's one thing for a bank to this, we're talking about Glass-Steagall, right? It's one thing for a bank to actually have a hedge fund where they have principal risk, right? What these guys are doing with structured note issuance is they're basically creating a cheaper way to fund themselves. So, because this all occurs through Treasury, right? It's the Treasury issuing the bond, and then the Treasury grants collateral back to the trading desk, and then the trading desk uses that collateral to create the hedge that aligns with whatever that note promised to pay back. And
Right.
the rate at which the Treasury grants the collateral to the trading desk. It's the difference. It's the spread between that rate and where they can fund in the public market that is
Yeah.
the advantage for them. And that's why they do this business.
So I'd explain again your guys' role in the process because you're
Sure.
not the issuer.
Correct.
What is your role and how does
So
that
we
work?
act as a sub-advisor to either the advisor, the trust and estate attorney, or the accountant, okay, that is arranging this GRAT transaction. We don't often deal directly with the client. We're usually for the most part, we're seeking to, and we deal directly with the intermediary. So we are a sub-advisor, and we produce the initial pricing, we assist with the analytics, and then once the proposal is accepted, we actually create the portfolio that goes into the trust, and then we manage that portfolio on an ongoing basis throughout the life of the trust. That's our role in all of this.
Okay, so let me just throw an example out there.
Mhm.
Suppose the attorney or the CPA or whoever it is, the family office, whoever it is coming to you and saying, we want to do a $50 million 5-year, 5%, assuming 5% is whatever the 75/20 is right now.
Sure.
GRAT. And that's as far as we've gotten in our analytics. Is that about where someone would bring you in?
Yes. Yes. Now,
Okay.
now there's an important thing here, Roger, too, which is that what we're essentially doing is we are enabling the use of the GRAT for that client that has $50 million in cash. Because there's a thing that happens here where practitioners are, in a sense, trained to recognize the potential use of a GRAT when they see those assets I mentioned earlier. So it is like an asset first mentality where they see the gas well, or they see the apartment building, or the highly concentrated stock position. And then that triggers, oh, I can use a GRAT here because these assets fit the bill. What implementing a GRAT with the structured note portfolio does is it unlocks the potential of a GRAT for those clients that just have a big pile of liquid assets. So if your client has this estate planning need or has this wealth transfer desire, right? But they only have liquid assets, now they can still qualify for use of a GRAT by constructing this custom portfolio.
That makes a lot of sense. And your role, so you guys, if a GRAT lasts for 5 years, you guys are involved for 5 years?
That's correct. And it's interesting because, yeah, because what will happen is over that time, certain tranches will underperform and others will outperform, right? And you need to make adjustments along the way, right? So if there's excess cash that's generated because a particular tranche produced more payout than was required for the annuity payment, that cash needs to be put to work with something, right? And the same is true in the other direction. If the tranche matures and it's shy of it's not able to fund the annuity, you need to make adjustments in the portfolio underneath to make sure things work well going forward. So yes, we're involved along the way as well.
And in the current business that you're running, is the name of the company is Structured GRAT?
So the actual company the product is Structured GRAT, and you can get information about it at structuredgrat.com. But the advisory firm is Regatta Advisors, and we're a New York State registered investment advisor.
Okay.
Yeah, so
Okay.
you can, if you just look up Regatta as in boat race. I'm an avid sailor, and I grew up racing sailboats here on Long Island Sound.
Yeah.
So,
No, I get that. Right. So how long has you started Regatta?
I started Regatta in 2010.
Okay.
Yeah, it's been around for a little while. And we also, in addition to providing the structured GRAT product, we are also involved in the support and distribution of structured note SMA strategies. There are many RIAs that offer structured note portfolio services, and we work with them and offer essentially act as a promoter, helping them distribute their products as well.
So I understand how this works from a estate and gift tax point of view. Are there income tax consequences? Suppose we have one of these and it works. Suppose we have, I'm just going to make up numbers, but let's just say that they work. And obviously, my earlier example of a 5%, that's the minimum, but there's going to be a big tax associated with that. So let's say we zero out the GRAT. Do you do zeroed out GRATs?
Yes,
Okay, so
that's our default issue is zeroed out.
yeah, so the actual numbers are way too complicated to do here in just talking. But let's just say we could do a 5-year 25% GRAT. That's probably going to be close to zero. If you pay 25, because in the first 4 years you'll pay 100%, but you had that extra 5%, blah, blah, blah. You got to do
Right.
that. So we zero it out, and let's make our numbers nice and round. Say it's 100 million, it goes in. So you got to pay back 100 million plus 25 million, roughly. Then let's say you're successful. And so successful is going to look like more than a total of 125 after we do everything that we're supposed to do, right? Let's say we have 150. So we got 25. Is that 25, that's subject to income tax when it goes to the next generation?
No, it's not. There is something going on internal to the trust, right? Where in your scenario, where let's say it's 5 years and it pays 125 million, okay? We take special care to make sure that the underlying investments that produce that extra 25 million do so in a way so that is subject to long-term cap gain, not income. So there's no income tax liability generated internal to the portfolio that can find its way back to the grantor. All of the underlying notes are constructed in a way so that the payouts are subject to long-term cap gain.
Okay, but some way or another, there's some kind of, okay.
Yeah, there's definitely a tax. Essentially, it acts like a normal grantor trust where the grantor is responsible for paying the taxes.
Right.
So what we try to do is minimize that tax burden by only using notes. Because you can do that, right? If I'm structuring it to begin with, I can choose, do I want that 25 million as a coupon that's paid out, or do I want it as a digital payment at the end? And we always select the configuration that gives us long-term cap gain treatment.
Okay.
Yeah. That's a
right.
great question. It's because that's really where the rubber meets the road, is making sure that you're making the right decision about how to construct not only the portfolio, but the individual securities that go into it so that you're minimizing the tax impact.
This is definitely don't try this at home.
That's right. You really couldn't, right? You need access to the issuers, and we use specialized pricing platforms like Halo, you mentioned. I actually use them to produce the pricing and the scenario analysis. So you do need like quasi-institutional access to the issuance capability in order to custom build each individual security. So you definitely can't try this at home.
Yeah, we've covered a lot of ground. I'm sure that somebody who actually has the potential need for this is going to need to know a heck of a lot more. How can people who want to find out more contact you to learn more?
Sure. So my direct email is E for Edward, so ECONDON at structuredgrat.com. And you can always contact us through our website, which is structuredgrat.com. There's a contact page there that reaches out directly to my team.
Okay, so the key info is Structured GRAT, all one word, GRAT, Grantor Retained Annuity Trust, structuredgrat.com.
That's correct.
Thank you very much, Ed. It's been fascinating.
Roger, thank you for your time. It's really been great. Appreciate it.
Great talking to you.
Thank you.
Thank you for listening to another episode of Sterling Insights, Stand Out and Supercharge Your Assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.